Ladies and gentlemen, welcome back to the channel. Tomorrow is going to be a massive day for our markets for really a couple different reasons. I'll tell you from the start, 3 months typically makes a trend. Jerome Powell almost seems convinced this latest round of inflation, the last 2 months for January and February of 2024, well, he thinks it's just a bump in the road, as he said many times, going all the way back to 2022, that you were going to see ups and downs with inflation, but it was going to trend back down to 2%. Well. A lot of people in the markets also chalked up January and February to seasonal adjustments. March's inflation numbers, that's what will solidify whether or not this is just a bump in the road or something more to be concerned with. Tomorrow's data is going to shape 2024 and how the Fed communicates to the markets. It's going to change how investors invest in markets in 2024 and really have broad implications. I think tomorrow could be by far the biggest inflation report for all of 2024 because of this potential change of trend. Or if inflation comes in lighter than expected, markets are going to say, well, the trend is still there. That was really only a bump for January and February. We should get allocated to different areas of the markets. So I think tomorrow could be very bullish for some areas of the markets, like super bullish, or not so bullish. And it all depends on what the number comes in as and what areas of the report are hot, what areas are light. I'll dive into that a little bit here in this video. But I will also tell you right now, I think inflation is going to come in lighter than expected. If I am wrong, though, you could be in for a lot more downside for the markets. So hit the like button, subscribe to the channel, and let me know what you think about this information down below in the comment section. So let's start with your inflation numbers tomorrow. Core inflation month over month, that's the big one to be watching. Last month came in at 0.4%. This month, you're estimating that to be 0.3%. Core year over year is expected to fall from 3.8 to 3.7% as well. So you are expecting core inflation to be quite disinflationary coming out tomorrow. But it's not like a big plummeting, but still progress nonetheless. Your headline inflation rate month over month is expected to fall from 0.4% to 0.3%. And your year over year headline is expected to actually rise from 3.2 to 3.4%. I'll tell you right now as well, your headline numbers don't matter. It's all about the core, specifically core month over month. Now, how these numbers work is they actually come out at a decimal point. Like 0.3% is not the number that actually we get. Most of the time, it's like 0.28, 0.29, and gets revised to 3. If you come in at 0.25, you will still get revised to 3. To the upside, to the hotter side, if you come in at 0.34%, you're going to get revised down to 0.3%. And that's important because if we get 0.25% or 0.34%, that's quite a big difference there. That's almost a 1 point difference from the low to the high range, but you would still round to 0.3% on both directions. So what the actual number comes in as is going to be important. Let's say you do come in at 0.25 and you get revised up to 3. It's going to look like inflation met expectations, but it actually came in well below expectations. If, again, you come in at 0.34%, it's going to look like, it came in line with estimates, but it was actually hotter than estimates. I think that's important to point out because Wall Street pays attention to the actual number, not just the number that we see on the headlines, not the rounded number, but the actual number. Now, in my opinion, if you want my opinion, I think inflation is going to come in roughly around 0.15%, so way lower than estimates. But I think it gets revised up to 0.2%. But under the surface, it's actually going to look much better than even 0.2%. The biggest reason why I believe this is the data that we got last week it was ISM Services prices. Now, if you think about the areas of inflation that have been hot, it's services, it's housing, it's, auto insurance, right? Technically part of services. Services have been really hot. Well, service prices, that's the direct component of inflationary data with the ISM Services numbers. Now, this is core PCE month over month on the charts. You tend to tick for tick go higher or lower depending on what ISM Services say. So for the month of March, you've seen an absolute plummeting, okay, down to 53.4 points. Back in December of 2019, you were at 59.8 points. So you fell more than 5 points lower than pre-Roni Rona. That's a big deal. Okay, and a lot of the disinflation that we actually seen in 2023 coincided with a sharp decline in ISM prices paid. And you're seeing that again. You're back down to the lowest numbers you have seen since the Roni Rona crash. And odds are this does mean inflation's going to come in weaker than expected. Now your headline might come in a little bit stronger because of energy, because of food, right? The areas of CPI that the Fed really can't control at all. Oil's traded, food's traded on global markets. So the Fed can't touch that at all. It has virtually no impact on that at all. But services domestically, prices paid for services really plummeted in March. And I do think that sets you up in a favorable way for tomorrow's data. Now, if you think about 2024, it's been hotter than expected inflation, better economic activity. The better economic activity part has really won the narrative for investors. Investors are like, hey, if inflation is a little bit higher, that's fine. The economy's doing well. But the markets themselves have seen some drastic changes in 2024. Not everything is doing well or has done well. Small cap, interest rate sensitive names, they have not done well at all. You can see from November, early November, the percent of stocks above their 50-day moving average was as low as 15%. It rallied to 86%. That was a very strong, broad-based rally. At this point, it was because inflation was falling just month after month after month. It looked like the Fed was getting ready to start cutting rates in March. Yeah, in March. We would have already had a rate cut by now if inflation would have come in weak for January and or February. That did not happen. So what started to happen at that point? Well, the average stock, your interest rate sensitive small cap stocks started to decline. And you fell to as low as about 37% of stocks above their 50-day moving average back here. Now you're back up to 57%. Now, for firms that need to be invested in the markets, they're sitting here, they're saying, hey, if the economy gets a little bit weaker, if the Fed doesn't cut rates as many times as the markets expect, what companies are going to be able to put up good numbers, good growth, and good EPS? That's your big tech names. They're really being seen as like bulletproof companies at this point. Whether they are or not, that's really not the debate. So money has flowed into those areas of the markets that are not dependent on the Fed. Because you went from the start of 2024 pricing in 6 to 7 rate cuts down to only 3. And you're getting pretty close to pricing in only 2. If you look at the Fed funds futures probabilities for the December 18th futures contract, there's a 33.8% chance of 3 rate cuts and a 29.8% chance of 2 rate cuts. 18.1% chance of 4 rate cuts. So you're pricing in 3 rate cuts for 2024, but you're pretty close to only pricing in 2. And instead of the first cut being in June, the markets are now expecting, well, actually, that flip-flopped. Yesterday, you were not pricing in the first cut in June. Today you are. And that's mainly because of the decline you are seeing in treasury yields. If you look at bonds today, they're down about 6 basis points. So it's pretty volatile what the markets are expecting. Yesterday, you were expecting the first cut in July. Now you're expecting it in June. Doesn't really matter. You will start to see more cuts priced in by the markets if inflation does come in lower than expected. And what will that do For the money that is really pooled into big tech stocks, that money will go back into other areas of the markets, interest rate sensitive names, mid caps, small caps, your average stock. And also, if inflation comes in lower, that means the Fed won't have to stay as higher for longer. And maybe that means the economy will ultimately avoid a recession. So it's also good for the soft landing narrative, again, if inflation does come in weaker. Now, if inflation doesn't come in weaker, if it comes in on the higher end, I don't know what would justify that. But if it does, you're at a very interesting moment in time for the NASDAQ. The NASDAQ has found support at the 50-day moving average, this purple line right here. This was on April 4th and April 5th. If you get a bad CPI report, the NASDAQ's probably going to fall under that 50-day moving average, and that sets you up for more downside down to at least that 100-day moving average at about 418.45. That could represent from here downside of about 5%. And that would be my expectation if inflation does come in hotter than expected tomorrow. And I think you just see a generalized underperformance of your small cap and small cap stocks, interest rate sensitive stocks, the whole shebang. If you take a look at the 20-day moving average, NASDAQ doesn't look that great. You're under that 20-day moving average. Whereas in context, if you take a look at IWM, small caps, they are actually holding support at their 20-day moving average. In a weird way, if inflation comes in lower than expected, you may actually see the NASDAQ maybe not be red on the day tomorrow, but not nearly as green as the Russell because of, you'll probably see a lot more stocks going up tomorrow. You'll probably see a broader market rally, but the money that's pooled into big tech may start to leave and go elsewhere into your small mid-cap stock areas. Now, another thing to consider is there's over $6.3 trillion in money market funds. For context, that is 3 NVIDIAs, market caps added together, a little bit more than that now. That is 3.5 Russell 2000s added together. That is over 10 Teslas added together, market caps, that is. That's a crap ton of money. And a lot of that money might start to come back into our markets as well. So that is something to also consider. Now, we also get the FOMC minutes coming out tomorrow. People make this a bigger deal than it is. It's backwards looking. It's basically a transcript of the last Fed meeting. So markets really don't care about that at all. And I'm not expecting it to have much of an impact on the markets. Considering CPI comes out tomorrow, that's going to be the biggest catalyst overall for our markets. Now, again, as I said, it wouldn't surprise me if the NASDAQ or the S&P are up 0.5% apiece and the Russell's up 3 to 5% just because of the underperformance that has been so massive in 2024 with interest rate sensitive names. If inflation comes in good tomorrow, if inflation comes in bad tomorrow, small cap stocks are going to get absolutely destroyed, and the S&P and the NASDAQ are going to do well or do poorly also, but probably do much better than the Russell. Now, if you take a look at the Russell's actually, like I said, been holding up support at that 20-day moving average. That looks great. Now, over the past 2 days also, you have seen 10-year Treasury yields be very volatile. Yesterday, yields were up 5 basis points. Today, they're down 6. And the Russell has been outperforming the last 2 days. Right. The Russell has been leading into this CPI report, which is a pretty good sign as well. Now, the VIX is up 3.5% today. It was up as well, like 2% or so yesterday. So there is definitely not a rush for safety, but there is definitely some demand for safety assets in our markets. Now, the VIX measures S&P 500 puts and calls. So if there's more puts being bought on the VIX or puts being bought on the S&P, the VIX goes higher. If there's more calls being bought on the VIX does go lower. Now, I think this decline you've seen over the past couple of days for the NASDAQ, for the Russell, sets you up in a more favorable way heading into tomorrow's report. Just my opinion. So let me know what you think about this down below in the comment section. To be honest, I think the Russell could rally quite a bit if inflation comes in, better than expected over the next coming, 2-3 weeks or so. I think the Russell could rally up to about 225. and that would be about 9.5% from here. And I wouldn't be counting that out at this point. I mean, even just consider you're in this bullish channel. If you do break out to the upside from here, that could lead to an upside move of 217, 218. If you get above that, then things start to get a little bit crazier to the upside. Nonetheless, let me know what you think about this information down below in the comment section. Hit the like button, subscribe to the channel. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.